Welcome to episode 88 of Accessible Finance for Retirement. I'm Eric Johns.
And I'm Rachel Johns.
Let's dive in.
All right, Eric, we are going to continue our segment on listener questions.
Okay.
This one is very specific.
Great.
Okay. So everyone hunker down. Bear with me on this one. I met with a CFP, fee-only, fiduciary retirement planning advisor.
Lots of good words. I'm so happy right now.
You like all of them?
Those are great words.
Okay. He assured me that our retirement projections look very good.
Okay.
With a 100% chance of success based on current assumptions.
I have a lot to say about that, but let's finish the question.
Do you want to weigh in now?
I
Do
don't
it
know.
while it's relevant.
You think so? Okay.
Yeah.
All right. When we talk about probability of success, what they're saying is usually that they've run Monte Carlo analysis, which takes like 1,000+ projections of a variety of market returns on an annual basis, or asset returns on an annual basis, right? Well, market returns, but it's various markets. Sorry, that is probably not important to 98% of our listeners.
Nope.
So they're going to take this Monte Carlo analysis and they're going to find out what percentage of the time, right, your probability of success, you finish your plan, which means you end your plan, you die, you pass away with $1 or more in the bank.
Yes.
And every time you have $1, they count that as a win. So we're taking your wins, right, and dividing it by the total, and that's your probability of success. So he's saying 100 out of 100 times, or 1,000 out of 1,000, or 10,000 out of 10,000 times, you have finished the plan with $1. What that means to us is that you should probably increase your spending or set some very concrete goals, because that's high. That's really high, right? So like typically what we would do is we would target a range of about 50 to 90% probability of success. And you might be saying to yourself, wait a second, I don't want to fail 50% of the time.
Yeah.
Well, the idea is if you're working with an advisor or a planner, you're not going to fail because you're willing to make adjustments.
Right.
You're going to turn a dial. You're going to pull a lever when you see yourself hitting the wall. You're not just going to allow yourself to hit the wall.
It's ongoing planning. And so
But
that number is static, right? So if you're at a 55% chance, that's 55% if you do nothing differently.
Correct.
You change
But
nothing.
the idea is when you've run these scenarios with Monte Carlo analysis and planning software over time, you'll notice that your clients will tend to have a ton of unspent dollars in the bank if you target probabilities that are incredibly high.
Yeah.
So as long as you and they are willing, as long as you as a professional are comfortable with the idea that your client can make adjustments, right? Because to be clear, there are some clients where you know they're not going to cut back on spending because every month you've told them to spend $12K and they spend $20K.
Yeah.
You know what I mean? Like you understand you're not going to tell that person, hey, okay, instead of spending 20, let's ratchet it down to 18. Like there's no world where that's going to happen. So
It's
that's on you to
very
figure it out as a professional.
individualized, for sure.
Right.
And
but my point here is simply, if it's 100% of success in our mind, that's already a topic for conversation because it's very likely that that's too high.
Chances are you're foregoing many current opportunities in your lifetime.
Correct. Exactly.
And the whole point is to be able to balance your goals while you're alive with your goals once you have gone.
And just to put a little bit of context around that, because we might get I might hear that if I weren't in this business and think, hold on a second.
I have kids.
Eric
I want to
and Rachel,
leave more than
exactly.
$1.
I want to leave
that's what I
this.
was gonna
I'm
answer
happy
too.
with having a large amount at the end of plan because I want to leave it to my kid.
Correct.
Okay. Well, we just want to provide the optionality to clients or anybody that's interested in this, right? So listeners, that you might be able to achieve these. You might be able to give your kids maybe $20,000 a year, maybe 30, maybe 50, right? Maybe you can buy them a house, a car. Like, would you enjoy that? Would you enjoy the smile on their face when you give them?
I will say the majority of our clients who have legacy goals tend to enjoy watching their
you get to share
children,
in the
their family enjoy.
Yeah, you get to share in the experience, right? You can go buy the family a trip to Vail, Colorado, for example.
I think it also tends to be at times when families need or could benefit from the money the most, right? Chances are later on in their professional life, they're in a better financial position than earlier
That's
on.
a really
when their
good
kids
point.
are young.
That's a great point. Yeah, when people are in their 50s and 60s, and ideally, you're going to live long enough to see your kids in their 50s
80s,
and
90s,
60s, right? Then they're going to have less use for the dollars.
Right.
Like think about your own life. $50,000 means a whole lot more to a 20-year-old than it does to a 55-year-old.
Especially a 20, 30-year-old new parent. Right, we've got a grant.
Right, yeah.
Those expenses add up so quickly.
You're paying for tuition. So there are all kinds of options there that we would just want to make you aware of because 100% is high. right? And if you're willing, if you're disciplined,
Very
and
high.
it sounds like they are already by the tone of this question, but I'm
Yes.
excited. Let's
Very
keep
rare.
going.
Okay.
Sorry for the derail.
But I do think that's important. I think it's important just to know that, like, if somebody came to us and we're like, look, your plan says 100%, it does not mean you're set. You don't need help or guidance. It's at least worth having a thought partner kind of walk through what some other options are. Okay. So the CFP fee-only fiduciary retirement planner advisor assured him their retirement looks great.
Okay.
He looked at their investments, which are currently invested in Vanguard TIRAs, Roth IRA, and brokerage accounts.
Okay.
This man states that simplicity in investments is important to him.
Got it. Heard.
Okay. He says that they are invested in 4 funds. The first fund is the Total U.S. Stock Market Index Fund, VTI.
We're happy.
Total International Stock Market Index Fund, VXUS. I was like, so many of these are awfully familiar.
Yes, they are.
Total U.S. Bond Market Index Fund, BND.
Yes, ma'am.
And the Total International Bond Market Index Fund, BNDX. Okay, so this is their current investment.
Got it.
The CFP recommended a more complex allocation using the following ETFs. VOO, which is the Vanguard S&P.
Okay.
VYM, which is the Vanguard High Dividend Yield ETF. VUG, which is the Vanguard Growth. VTV.
Value.
Yep, value. VOM, which is mid cap. Vanguard mid cap ETF.
Mid cap with VO.
Oh, maybe it's VOO.
That's okay.
No, VOO is the S&P.
No, VOO is S&P. VO is mid, I believe.
Oh, I don't know. He may have just
It might be it might be another fund that I'm not familiar with. That's okay.
VOE, which is the Vanguard mid cap value.
Oh, I don't know what that is.
VBR, which is Vanguard small cap value.
Use that one.
VEA, which is the
International
developed. Yep. VWO, which is the emerging markets. Yep. And then additionally, he recommended for the fixed income only for TIRA, he recommended VTC, which is total corporate bonds.
Okay.
BNDX, which is the international bonds. Yep. And then USHY, which is iShares Broad USD High Yield Corporate Bond ETFs. Okay.
This is interesting. I feel like we don't talk about investment allocation enough.
We don't.
And so I don't want to give listeners the impression that we shy away from it. I love it.
Yeah.
Love it. I listen to Rational Reminder. Yeah. Again, shout out to that podcast. They're amazing. You guys should all listen to it as well if you're into this. They're super granular, right? You have to really enjoy Ben Felix's analysis of peer-reviewed journals and interviews of academics.
Granular.
Rachel's heard it a couple times. I make her listen to it.
Our children have also heard it a couple times.
It's fantastic, but it's very, very in the weeds,
yes.
right?
You have to be wanting to dive in.
Yeah, we're talking about risk premiums with implied volatility on covered calls versus
it's a lot.
Actual income. So like, there's a lot that goes into it.
But I do think it's worth having an episode for us that focuses on
investments. Well, this could be it. All right, so let's dive in. Okay.
So wait. So let me say what his
what
concern is. Right. So the CFP he stated what he had. The CFP's recommended, more. And so the man says, I am trying hard to wrap my head around the more complicated, diversified recommendations. He explained how adding more asset classes and separating the assets out of one holding, like VTI, allows us to keep the expected return rate, but decrease the volatility. He also stated that it allows us to allocate certain asset classes to different accounts and weight them in a way that better aligns with our risk tolerance. Additional benefits, he stated, were tax efficiency, by where we're holding the growth/income asset classes combined with the weightings to give a smoother ride. I'm still learning and would appreciate some input on the pros or cons of moving investments to this more complicated asset allocation or sticking with our current funds.
I really like this guy or gal. Yeah. Do you know if it's a guy or a gal?
It's a guy.
It's a guy. I really like this guy. I'm a big fan. Okay, so I'll tell you why I'm a big fan. First, the 4-fund portfolio that he had, perfectly fine. Absolutely satisfactory. Could have written it. Could write it out forever.
I was like, when I recognize the
100% fine.
The tickers, okay? I know.
Absolutely fine.
Yeah.
Questions are around how much more viable is this CFP's broadened diversification, more granular portfolio. I would say that it is objectively worse in a lot of ways, right? So let's
The
articulate
proposed portfolio you're
this. Yeah,
saying?
it's nonsense. And so here's why. Like, yes,
Tell me.
you're like, if you want to split up VTI, okay, into VOO, which is like its large and mega cap component, and then maybe VO for its mid cap, which actually, if you look at it, it's not really necessary. You can just, if you look at the VTI, it's mostly just VOO and VB, right? VB is small cap, sorry. So it's mostly just large cap and small cap because the small cap has some mid and some micro. But the idea is that you could essentially break it down to just VOO and VB, right? That would be the breakdown that he's talking about, right? So we're taking these like aggregate funds and we're just kind of splitting them up into their component pieces. That's not what this CFP did, okay? That's not at all what he did, actually. So he took VTI, all right? And then he broke it down into VOO, which is the S&P 500. Absolutely fine. Large and mega cap. We're happy with this, right? But then he has VYM. So now we're overweight dividends, right? Then VUG. Now we're overweight growth. And now VTV. Now we're overweight value. So VUG and VTV are all, and VYM, they're all large caps. So he's got the large cap that includes all of them. And then he's overweighting individual components, but presumably at relatively equal distributions.
Yeah.
So there's not actually a clear and coherent plan here. Does that make sense? We're not in a dividend strategy. We're not in a growth strategy. We're not in a value strategy.
Yeah.
And we're also in all. So like, you know what I mean? Like if I were going to say like, we're going to be overweight value, then I might buy VOO and VTV, right? So now we're owning everything and then a little bit more of the value stuff. We're adding that as icing on top. Okay. And we're not doing that here. We're also going to be overweight mid cap when you have any mid cap section, because if you look at the VTI breakdown, they're mostly going to be large and then only a small amount of mid and then small, right? So if you buy VB or if you buy US small cap, you're going to gain some mid cap there accidentally, right? VB just holds mid cap. It says US Vanguard small cap fund. I'm very aware of that. But if you go and look at the breakdown of the companies by market cap and how they're separated, you will have mid cap exposure there, right? So I'll get out of the weeds in a second, I promise, but this is important. VBR, the small cap component, VBR is Vanguard small cap value, right? So that's got to have a value tilt. He has what was this? VOE was like emerging, was mid value or something like that?
VBE, you said?
No, VOE. VO is
VOE
mid.
was the Vanguard mid cap value.
Okay, so he's like trying to overweight value at various times, but there's also like a kind of a growth component, which you would think of as not exactly in conflict, but they're different. And then he's got VEA and VWO, right?
Yeah, so he's got developed markets, emerging markets.
Yeah, that's the split. So VEA and VWO is actually a perfect component split of VXUS, which was one of the large 4 funds that they had talked about
Exactly.
Why would you
ever
go from the aggregate to the individual pieces, right? And here's a good question. Like that's a good question. You would do that if you're looking to do things like tax loss harvest. Does that make sense? So tax loss harvesting involves your position going down in value, you sell out of that position, and then buy into basically the same thing, right? So if VOO goes down, I sell VOO, take the tax loss on my 1040, on my tax return, right? And then I buy into SPY or any of the other S&P tickers, right? Like FTAIX or whatever. Like I'm going to go buy into another fund that essentially owns the S&P 500.
Is that not feasible with their current 4?
You could do it with VTI, right? But then VTI, like if I have VOO, right? So if I have VOO and VB for VTI, right? So my VTI is my whole, and then I have the 2 parts. Now I have essentially double the chances, because then if small caps go down, I can do it with just the small caps,
right?
Even if the large caps have exploded
without
in growth.
having to do the whole.
So like in early 2020s, you could do something like that. Like large caps were killing it, small caps not quite so much. So if the market pulls back, you're more likely to be able to sell the smalls and rebuy. So here's why that's useless.
It sounds like you're advocating though for like an ingredient mix rather than like a final.
I don't hate the ingredient mix. I don't hate the ingredient mix, but I hate some of the choices of the ingredients. The idea is fine. The concept I'm okay with, right? And it's not just, I'm not trying to nitpick here. I'm not talking about like, I like Avantis as a small cap manager instead of Vanguard because they like not into that right now, right? Not getting that granular yet.
Although you would be happy to.
Yes, let's do it though. Let's dance. But what I'm saying here is that we're nonsensically investing because we're overweighting and then underweighting like the same things, right?
Okay, so like I imagine it for our listeners who are kind of with you. Okay, correct me if I'm wrong here, right? So like if you look at their 4 stock holdings, their
4 fund portfolio,
right? If you look at that as, you know, a completed meal, right? Like let's say it's a loaded burger. It's got all of the fixings, right? And then you're like, well, instead, he's basically breaking down all of the ingredients. However, It's not breaking it down into the same ingredients that he had, right? He might like get
Yeah.
extra lettuce.
He's throwing some pineapples and jalapenos on there, and we may not,
Like,
may or may
that's
not
kind
want
of a
that.
weird burger.
Right. But also it's like the burger analogy in my mind kind of breaks down because you're going like really overweight on pickles and then really going overweight on the opposite of pickles, but I don't know what that is.
What ends up happening, right, is that if you end up going overweight on all of the condiments, then the actual meat patty is like no longer.
I mean, sure, yes. When you're overweight on everything, you're actually overweight on nothing, or like you're
Correct.
losing it, right? But even more problematic is if we look at the bond side, okay? So we had said that our initial 4 fund was BND, which is like the total aggregate bond, U.S. bond market.
Yeah.
And then BNDX, which is the total aggregate international bond market.
Correct.
Okay. That includes government bonds and corporate bonds at a ratio of, I believe it's about 70-30. Like if we're talking BND, I think it's 70% government and 30% corporate. Okay. Let's just assume that that's true for now.
To be pushing.
So let's assume that's true for now. Now when our CFP man, what? I dropped a pin. I'm sorry. I have another one though, guys. I'll never run out of pins. Guys, I'm never running out of pins.
So sorry, back to the,
you're sidetracking me when I'm already in the weeds. I'm amped up, guys. I'm ready to go. This is fun. Okay. Here's the deal, right? So we were in BND and BNDX. Also, we should talk about investments more. I mean, this is energizing, huh, guys?
Oh my goodness.
Are y'all feeling this energy?
See, he doesn't
You're a
need
little Will
coffee.
Ferrell? No, not at all.
Okay. So yes.
Here's the deal.
Yes.
We were in BND
right.
and BNDX, presumably at like equal weighting, or doesn't even really matter. Point is, BND, if we're in it, has exposure to U.S. government bonds.
Yeah.
When CFP man broke us down, we no longer do.
Correct.
We're now in U.S. corporate
and
then high yield corporate. Whoo, do I not want that in the portfolio ever? And let's talk about why.
Yeah.
Why? Because bonds are a hedge against risk assets or equities, right? What we mean is we want the bonds to serve as a store of value when the markets tank. Unfortunately, high yield corporates have a much higher correlation with the stock market than government bonds do, right? So what we're thinking here is that we want to be safer so that we have something left to sell when the stocks tank.
Right.
If the stocks tank, we don't want our bonds to also tank. Correlation means they're moving in the same direction. Not necessarily the same magnitudes in the same direction, but if I'm going up, the other thing's going up, maybe not quite as high, right? But it's still moving in the same direction, and that's problematic from a modern portfolio theory standpoint, from a risk management standpoint.
Yeah.
Right? We're not getting the optimal risk-adjusted returns when we do things like this. High yield corporates, no reason to have this here. Another point that's a little bit more nuanced, but I believe our audience can follow, because they probably like listening to me talk about ridiculous stuff at this point, is if we're talking about doing this kind of a rebalancing, reallocation for tax loss harvesting purposes, presume like we've already established that we have the 3 tax buckets. You know, he has taxable, he said. He has a TIAA, which is tax deferred, and he has a Roth. Okay. So he has the taxable, tax deferred, tax free buckets.
He seems like, even though he couches his stuff of like, I'm kind of new to this, he seems to be playing the game quite well.
I was gonna say, and I love the way you said that. I also agree that he's playing the game quite well.
I do have 2 questions when
my diatribe finishes. Good luck.
Ready.
It's not no pausing.
I have questions.
Okay. One pause, but only after this. Okay. So here's the idea. If we are correctly allocated with VTI in our taxable account, it is almost guaranteed to be highly appreciated at this point. So doing this kind of a rebalance would create the taxable event that you're hoping to avoid. You would be, if you're selling VTI in a taxable account, if you're selling anything in a taxable account that you've been holding on for this long, like, maybe not the bonds. If their bonds are in taxable account, we can talk. But and it might not be as nonsensical as but point is, even if it's nonsensical to hold the bonds in the taxable account, maybe we just move BND or BNDX to your tax deferred, and then we buy your equity that we owned in your tax deferred in your taxable account, right? So we can shift those positions without having to shift the actual securities and the tickers that we're using. Right. But to talk about it as a risk tolerance thing, in my mind, is silly, given that we're having things that are increasing our correlation with each other rather than decreasing correlation, which means they're moving in different directions. I'll pause now. Sorry.
Well, that actually ties into the first question that I have. So the first question I have is, does this seem to you like somebody who essentially has bags behind the counter of just like pre-filled grocery, like lots of ingredients and groceries they put in bags that are already there? And they're like, give me your burger, I'll give you the bag of groceries, without necessarily looking at what the thing is that they're trading, so that it's not necessarily like an equitable trade. Like, does it
Like, do they have like pre-built models and
Yes.
they're just putting them in a
Yes.
model?
Does that feel like a pre-built, like this is like a thing I recommend to my clients?
Probably. I don't necessarily know that that's inherently bad, though. I think the answer to your question is yes. I wouldn't say that that's inherently bad. I would say that it's inherently bad if you've made a complex bag of groceries for no reason other than to create complexity and the illusion of outperformance.
That brings me to my second point. The second point here is, do you believe that if you are trading one item, right, or in this case 4,
right,
and getting a bag filled with 12.
What do we have? Is it 12? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Exactly
Yeah.
12. Yes, ma'am.
Yeah. So we're multiplying what you have by
3x,
3.
yep.
Despite the fact that this individual specifically said that his goal here was simplicity.
And he's doing it well, to be clear.
Yes.
He's got a globally diversified, low-cost portfolio here. I don't know what his allocations are. I don't know if that matches his risk tolerance, but that's what should matter.
But I think that, okay, the second question I have here then is, do you believe that for the general public, if they're giving you like a stack of 4 things and you're handing them this bag of 12 and you're like, it's, going to be amazing and it's kind of a semi smoke and mirrors show. Do you feel that offers some type of like psychological comfort to the majority of clients that are like, ooh, like this guy's doing something. He knows what he's doing.
Unfortunately, I think the answer almost certainly is yes,
I
right?
do too.
I think that's kind of sad because I think that's what advisors, not advisors, but advisors and or like planners, they're just people. I mean, this guy has a CFP. He studied for a hard test. He passed it. And he's probably, he may well believe himself to be doing the right thing. I would like to have a conversation with him. But the idea here is that I think people that are in the planning industry and are in the investment management industry are trying to like show their value.
That's what I was gonna
And they're
say,
trying to convey to clients, like, I know a lot. Like, put me in, coach. Like, this is what should be done. When it's not wrong to lean into the like simplistic 3 or 4 funds. I'm not saying it needs to be 3 or 4. Like, we like Avantis for small cap
but
and international.
I think that if you're going that route, right, where you're leaning into the simplicity, you have to be, if you're a holistic
you have to be
planner,
offering other value.
you have to be very good, not at just offering the value, but being able to communicate what that is. Because like we've talked about, the majority of people believe that the highest upside to working with a planner is that you have inside information on these stocks, you know where to invest, you know what's going up. And if you have someone telling you that, I would run. But I think that it's very possible that this CFP is doing a lot of really great things. Like, we're thinking like Titanic, like iceberg style, where there's a lot of stuff happening below the water that we don't see. But the thing that's most tangible for people, the thing that they access the most, the thing that we've seen some of our clients like look at the most is they're constantly looking at their balances in the stock market. They want to see it go up. And so being able to say, I have this expertise. There are these 12 things you currently afford, but these 12 are going to allow you to have like tax loss harvesting and things like that.
Yeah, and you'll use buzzwords, right? And like nobody really knows what you're saying. They're like, well, the volatility and you got the inverse variance. And we're talking about lower correlation, and that's going to be like that's going to create a lower beta of the overall portfolio, and we're going to hedge some of this risk.
Yeah, like there's all sorts of
everybody can talk the talk,
so
but
it sounds really good, and I think that overall, people planners in general, I think, feel like they can convey, truthfully or not, their value with investments better than in any of the other areas.
And look, that it is not uncommon at all for us to hear in a prospect meeting, okay, so your fee is 1%.
Yeah.
That means you're going to beat the S&P by at least 1%, right? And we're like, guys, that's absolutely not how it works. First of all, just so compliance knows, we never say yes.
No.
You're not allowed to promise returns, okay? We couldn't, even if we thought we could beat the S&P. We couldn't say it even if we thought we could. But the idea is that's not what we're talking about here. Like, you can, and that's kind of the problem for advisors. They're trying to set up a portfolio that essentially may position themselves.
Before you continue with the portfolio, I do think it's very important that we go back to the 1% comment that Eric made and make very clear that we do, though, in response, tell them that we can provide more value than the fees that we are charging.
Correct. Absolutely.
It's just not necessarily solely
it's in the whole picture,
investment.
Right? Exactly. Realm. Retirement planning, tax planning, education planning,
a
student loan
pizza,
planning.
and each slice is like a different thing. And if we're pinning all our hopes and dreams on that one sliced pepperoni. Like,
Absolutely. And look, there are many times where investments have been repositioned in ways that were provably better,
Yeah.
right? Like they just,
For sure.
empirically experienced higher returns than the client otherwise would have if they would have just
right.
stayed put.
Or lower fees.
Correct. Yeah,
right?
yeah, right.
There's
Absolutely. That happens a
multiple
lot.
ends of,
Yes.
or oftentimes it's both.
Yeah. Getting clients out of American
Yes.
funds and T.
But
Rowe
it's not
Price and
telling you like buy GameStop now, right? Like
Oh,
we
no,
don't have an
absolutely not.
inside scoop on any
Absolutely
of
not.
that. So yeah, I mean, it was such an interesting, very
This was fantastic. I'm
complex
happy.
question. I think the man who wrote it was really measured in being able to communicate what was communicated to him.
Yeah.
And I thought it was really interesting because we don't really talk that much about investments specifically, we talk about investment philosophy, but we don't really get into some of the concrete investment
Mm-hmm.
things here because, like we've said, we are not individual stock pickers.
Right.
But it is really important to understand like the pros and cons of.
Right. I just want to make sure that I was clear in what I said about this. It's not necessarily
put a bow in
bad
it.
to break a whole down into its component parts in terms of like securities, right? In terms of like a fund. That's not bad.
I think
and
you
it
even
can't-
talked
I
about
think
some
it's
of the
actually
benefits.
good.
Yeah.
Okay. But I think you better be sure that if your whole is AB, that you're not breaking it down into A, D, F, G. Does
Yeah.
that make sense? Like that's not okay. It needs to still be AB.
Correct.
A
I mean,
plus B.
like you said, it was literally adding like pineapple and jalapenos to
Yeah, we
to
threw
your
some stuff in
basic
here
American
that not
burger.
only wasn't part of the thing, but is representative of an entirely different and incorrect strategy.
Yeah.
Does that make sense? So like for fund, in my mind, was objectively better.
Yeah.
Granted, I haven't seen his allocations to
That's
which
what I
it
was
could be
gonna say. We
1%,
don't have
1%, 1%, 97.
Yeah.
And then we're just like, what are you doing,
We
man?
don't have the percentage
But
allocations, but you would assume
if
that
we're talking generally speaking, some kind
Yeah.
of 60-40 with, of his 60% equities, we're talking like 60-40 US international
Yeah.
or, 65-35, whatever. If it's in the realm of reasonability, we're pretty happy with the floor fund, especially compared to this.
And so like okay, so would you say that if you're making moves in a portfolio that it should be adding value?
Yeah, 100%.
So
It should just be deliberate. It should be intentional, deliberate, and
Yes.
should have a very clear investment thesis behind it. We tell people that all the time because there are people that are emotionally attached to specific
yes.
positions that they
Yes.
hold or will hold or whatever,
Or
right?
that they've seen grow. Yeah.
Yeah. So like we're just like, look, let's construct some framework around why we like this. What has to be true for us to like this? Like maybe we like JP Morgan stock because Jamie Dimon is the CEO and we're big fans of Jamie Dimon, right? I'm not saying any of this is true. I'm just giving you an example.
Yeah.
Okay. Well, what tends to happen is if you don't have real clarity around why you're there, Jamie Dimon might retire.
Yeah.
Okay. And then you'll still hold your JP Morgan stock and you'll just change your reason.
Yeah.
Right? You haven't written it down. There's no accountability
lot.
there. So you're just like, well, they do
It
pay a
just
good
feels
dividend.
good. It feels
Wait,
weird
so-
letting go of it.
Right. But I thought we were there because Jamie Dimon, not
Yeah.
because of the dividend.
Right.
I didn't think we were there for dividend growth. Are we there for dividend
Yes.
growth? Okay, let's talk. We're
We
there
do
because they're the
see
biggest
a
bank
lot
in
of,
US by
like,
assets, right? Like,
Backwards or cyclical reasoning to avoid.
yeah, people will back
ripping the
themselves into
Band-Aid off.
decisions that they've
Yeah.
already made. And they're kind of, they're attached to it emotionally.
Yeah.
And so they'll stay there. So we
I
just
just-
want to get really clear about why we're making moves,
Yeah.
what our investment philosophy is, and then what our
Making moves.
thesis is for each position that we hold.
And so I think, the best way to kind of wrap up and sum this up is essentially like, the poster said that the CFP stated that this allows them to allocate certain asset classes to different accounts and weight them in a way that better aligns with their risk tolerance, and that the additional benefits are tax efficiency. Those three things seem inherently wonderful things. They are not uniquely tied to the 12 investment options that he had,
Correct.
right? So,
And I would argue they're not actually doable because his taxable account has been held for a long time probably, and it's going to have a highly appreciated asset. So to sell it, you're actually creating the capital gain that you're saying you're going to avoid with increased tax efficiency.
right. So timing matters.
Yeah.
hugely
And also just the solutions are non-unique. What I mean by that is that's one of my favorite things to say, but
I know.
it's silly. I know it's like Jesuit debate stuff. But what I mean is you can do the tax efficiency part of that without his security selections that he's made.
Right. That's
Does
what
that make sense?
That's what I'm saying.
We
I
can
don't think
we can put the fixed income, the
Yeah.
BND and the BNDX, we can put that in the tax deferred
Yeah.
TIAA without going to VTC, BNDX,
Yeah,
and
it
USHY.
seems that he struggled to make that connection.
We're just conflating the two and using
three things
buzzwords.
the three purposes that he mentioned. He failed to explain how those 12 holdings accomplish those things.
But yeah, great question.
Bottom line,
really happy with that one.
We liked his initial one. Okay,
Really
beautiful.
fun.
Well, that was a full episode right there. So our next episode, we'll have some more questions.
Alrighty.
Until next time.
Thanks, guys.